Welcome to Barchart's weekly series of webinars designed to help you, the trader investor, better understand a variety of trading ideas and concepts, as well as the pages and tools Barchart provides to help you make a more informed investment decision. Today's subject, cover call buy right strategy. The cover call strategy is one of the most widely used options strategies. Its primary goal is to increase income through ownership. Now, it will outperform ownership alone, even if the stock price falls and stays the same or rises steadily over time. The buy right aspect of the cover call strategy looks to take advantage of ownership of a stock at the same time selling a call options with that expectation that the stock price will rise enough that the stock will eventually be called away, but leaving the trader with a handsome reward. Hello, everyone. My name is John Rowland, and welcome this afternoon. I'm Barchart's head of trading education, and today we're going to take a little bit of a different tack of this primary goal of covered calls that benefit through ownership. And our premise it will be is we're going to take ownership with the understanding that the stock will be eventually taken from us, but not before we get paid off a return by our design. With us today is my partner and our moderator, Barchart's project director, Gene Baker. Hello, Gene.
Good afternoon, John. How are you?
I'm doing fine. It's hard to believe that Thanksgiving is just around the corner.
I know. I know.
Are you getting ready or not even yet?
Not even.
Are you guys, is your family a turkey or a ham family? And most people are turkeys, right?
Oh, you know what? We're a little bit different. Turkey and maybe some sort of pasta, shrimp, some sort of fish dish. Yeah.
Ooh, can I come over? That sounds yummy.
Anytime.
Okay, let's get to work then. This webinar is for educational purposes only and should not be interpreted as a recommendation to buy or sell a security. Options trading is not for everyone, and decisions to buy, sell, hold, or trade in securities, commodities, or other investments involves risk of loss and should be only taken in conjunction with advice from a qualified financial professional. And under no circumstances shall we be liable for any loss or damage you or anyone else incurs as a result of any trading or investment activity that you or anyone else engages in based on information or material you receive through barchart.com or our services. All right, so the buy right call strategy is basically we're going to purchase the stock at the same time we're going to sell a call. We're going to buy the stock and write the call. The strategy itself is really best designed for those traders who believe that the market is in a bullish or has recognized a steady uptrend in that underlying stock. Now, the strategy can perform even if the stock price holds steady or even falls slightly, but it will underperform if price rises dramatically. And that's because it is limiting the profit potential by the call strike. Maximum profit can only be achieved if the underlying stock is actually called away from us. In other words, the price of the stock is greater than the strike price at the time of expiration. So there's two components here for maximum profit. Stock price above our strike price and at expiration. Now, just because the stock price is above the strike price, it does not guarantee maximum profit. You still need that advent of expiration. Now, we will talk a little bit later briefly about the options to undertake in the scenario of price above strike, before expiration. And the strategy offers a limited downside protection by the amount of credit we're going to receive from selling that call. Now, this is commonly called the break-even point or the break-even value. Now, there's a balance here, a give and take, so to speak, of how much downside protection we can create. Now, the greater the protection, there's going to be some variables we're going to need to look at. For instance, the greater protection, I might have to sell a call of greater time value, or I might have to sell a call in a stock that has greater volatility. But if I'm trading a less volatile stock or less time, then that could come to an expense of a lower profit potential. So there's three basic considerations when we start to look at cover calls, how we're going to break down the cover call and how we're going to kind of compare them to different possible candidates. And the first one is our potential return. The call I write gets exercised. In other words, price goes above my strike price. Break even, or break-even point. Now, this is how much premium I'm going to collect minus my initial costs. Now, when we go to the screener, we're going to look at something called the BE percentage, the break-even percentage, and this is going to allow us to do that comparative analysis. Static return. This is the unchanged scenario. Price remains between our strike and our break-even value. And for our longer dated options, we will look at dividends and if they come into play. Now, dividends is good for us because we own the stock, but it's also bad because the market will discount premiums of the calls that we're going to sell based on the expectation of that dividend being paid out. Okay, so those are kind of the ground rules that we're going to look at. So let's go to the cover call screener options page, and if you don't know where that is, there's options, and there it is, cover calls, and that's where I'm at right now. Now, before we get started, I do want to point out here on the top here that we have done a cover call webinar in the past. Now, this one was more about ownership, already having owned stocks and learning how to create a continuing income, generating income from those stocks that we are already own. Today's session is more about adding value to a momentum trade using the cover call strategy. So let me walk you through just some of these columns and what are the things that we need to be aware of as we're looking at them. First of all, here's our symbol. This is the price of our current price of our stock, the strike that we're going to sell, and then something called moneyness. Now, moneyness is this relationship between our price and our strike price. Now, what we're going to do on this one is we're going to think about when we try to pick a stock that we're going to trade, do I want to take a greater moneyness, which could create a greater profit potential, but also when I look at the expiration date of my call, that's the time I need for me to get that maximum profit I want to get to expiration. So the question then becomes, do I believe that in this case, will this stock rise from $10.30 to $12.50, or a 21% increase in price between now and December 17th? So we can use this as a variable in terms of how much moneyness I want to try to achieve, but do I believe that stock is going to rise that much in that amount of time? I might want to be a little bit more conservative, right? Let a more realistic target instead of trying to pick one that maybe is much greater, or in this case, maybe 25%. Not that it can't happen, just I might want to be a little bit more conservative. The expiration date, the date of when our call is going to expire. The bid price. Now, the bid is what the value of our calculation here is going to be based on if I sell that call. Now, you could set up a trade where you could pick a price of your own. No guarantee that you're going to get that price, but that's how we calculate it on this page based on the bid price. The net debit. Now, the net debit is our break-even price. And sometimes it's referred to as our net investment price, our purchase price minus our credit. So in this case, we have a purchase price of $10.30. We're going to take in $1.45 worth of credit, and that means that our break even, our net investment, or our net debit is $8.85. And then there's that downside protection we talked about, that break even expressed in a percentage. Again, this will be a comparative for us in terms of how much downside protection I want to create in my trade. But again, there will be a trade-off. The more downside protection I need or want to create, I might have to sell more time, or I might trade a stock that has more volatility, and that might not be something that I want to do. So we'll look at that in a moment, but again, this will be more of a comparative process for us. Volume and open interest, I think those are kind of self-explanatory. And then our delta. Now notice that delta here is expressed in a negative, and normally delta is expressed in a positive, but because we're selling a call and a rise in price of our stock is going to impact our call negatively. That's why it's expressed in a negative. Then we have our IV, or our implied volatility, and this is the implied volatility of our strike over the time or life of that option. So again, when we look at implied volatilities, higher volatilities generally create greater premiums, juicy fat premiums. That's what we want. But higher volatilities also create greater price risk to the upside and to the downside. So there will be a trade-off we'll look at. Potential return. This is our max profit if price gets above our strike price at expiration. The difference between our purchase price and our strike plus that credit that we're going to receive, including dividends if it's applicable, divided by our net debit, or our net investment costs, right? And so if you want to see that calculation, you can go into our help section. And then finally, our annual return. Now, the annual return assumes potential return over 365 days. So it's not a realistic value. I want you to be aware of that, right? In other words, in this case, it says your annual return is 500%. Well, that's because you'd have to get 40% return every 30 days on this particular stock. That is not realistic, but it is a valuable tool in comparison. We're only going to use it for comparison purposes. When I look at multiple strikes, when I look at multiple stocks, and most importantly, when I start looking at different expiration dates, this is going to help me start to determine which ones that I'm going to focus on. All right. So what do we say were our three considerations? Break even, potential, and static. So we do have our break even, we have our potential, we don't have our static. So let me show you where you can find that. So under set filters, I'm going to go in here where it says options analysis. I'm going to pick potential return, and I'm going to open that up, and we have two filters that are that unchanged scenario. One is called the potential flat return, and the other one is called the static return. Now, the potential flat return is our credit received divided by our net debit, our break-even point. And the static return is our credit received divided by our purchase price, that initial investment. Now, I don't have a preference for either one of these. They're just comparative tools for us. Just that the potential flat return will give you a greater value because you're lowering that cost because you're taking the credit off that net debit. So I'm just going to add that to my filter, and I'm going to show you that in a second. And what I want to show you before we go into deep into it, well, let's just talk about this static return. So kind of as a rule of thumb in general terms, again, every trader is going to be a little bit different, based on what their goals are, based on their risk tolerance. But for lower volatility stocks, our unchanged scenario, and I want to get paid, right? If I'm going to put money to risk, well, we kind of want to see those static returns produce at least somewhere between 1 to 1.5% on a per month basis. If I'm trading a more volatile stock, then I could raise that to maybe, let's say, somewhere 1.5 to 2.5. Again, this will be my low end threshold, just so that we get paid for taking some risk. All right, so in our screener, we have our main view, which we just walked through. Now, we also have dividends and earnings, and this is going to be important in our strategy as well. First of all, I want to know if I'm going to receive a dividend during the time of I own the stock and before my expiration. And what we're going to do is we're going to look and see if our ex-dividend date is inside of our expiration date. So you can see here under and low, we do see our ex-dividend date is the 18th, and our expiration is, excuse me, that's the January. I thought it was the 11th. Apologize. So this one wouldn't be a good example. But we can look at that. So looking at when is our ex-dividend date and when is our expiration date, and that will have an effect on my potential profit. Also, we can look at our earnings. Will our earnings be one of those catalysts that could push price for us? Filter view. So a filter view, any of the filters that I add to the screener are going to appear here and allows me to look at those variables. And loading up. And there's our static return. We added it as a filter, and there it is. Now, again, when I start thinking about static return, I want to make sure that I get, that very small return. Notice that if I go to sort this page based on static return on the low end, you see a lot of the options that are being generated in our screener have zero or no static return. Well, first of all, look at the time to expiration, days to expiration, only a few days, right? When we trade options, there's something called theta decay, and we'll talk about that in a little bit more, that our premium will shrink in value as we get closer to expiration. So there's not a lot of juice, a lot of premium in these trades. And then finally, we have our options view. In our options view, if I add any additional filters that are related particular to that particular option, that strike. For instance, if I add a Greek, gamma or theta, what are the couple that would come to mind? That's where you're going to find that here. All right. So we talked about some of the aspects of how I can start doing some comparisons or things I want to start considering. And one of the things that we talked about was that break even, how much I want to create to the downside on protection to allow me to take that trade. So I'm going to add that. Now notice here we give you a default right off the bat of 10%. And that's kind of really where we're going to start thinking this threshold at maybe 10%. Now, if I look at the results of those scenarios where I'm going to get 10% or greater, for instance, here is PROG, and it's giving me a 35% downside protection. That's a lot of protection in terms of the price of this stock. But there's a trade-off, and that trade-off could be might have an option that has a lot of time premium. That's why we're getting that juicy premium. Or, as you can see here, it could be a very high volatility stock. So again, as each trader, their appetite for risk, this could be a variable that you want to start looking at. How much downside protection that I want to get versus how much volatility I'm willing to take on. Volatility is good, juicy premiums, but too much volatility, well, then we might run into some greater risk. One glass of wine, not so bad. You start drinking 10 glasses of wine a night, then you might have a problem. But even if we changed our break even, for instance, here we're just looking at 10%, that was that threshold we look at. Notice that a lot of our IVs are still in that 100%. But if I come back to my set filter and I'm willing to give away a little bit of downside protection because I'm confident that I'm finding a stock that has positive momentum, and let's just look at the range between 5 and 10%. What we're going to notice is that some of the stocks that will give us a lower break-even potential or value might actually be lower volatility stocks. So notice here we have a lot of 5% downsides, and now look at a lot of these IVs, 81%, 72%, 61%. Yeah, volatile stocks in terms of implied volatility, but not crazy volatility, right? Not 200%, not 300%. But also notice that our returns are going to be a little bit less. But on the other side, that comparative analysis, my moneyness, here is a stock that I only needed to move 9% between now and December. That might be a lot easier for this stock to do than, for instance, moving 25% or 30%. So this is a balance, depending on how much risk I want to take on, how much downside protection that I want to get, and what is that potential that I'm going to get. So as generally as a rule, the lower downside protection you're going to get, the higher the probability you're going to get a chance to have a greater potential return in terms of actual returns. In other words, if I can get a 10% movement, that is more likely in an event than getting a 25% price movement. All right, so that's just one way we can start filtering down the cover call screener. So what I've done is I've created a screener of my own with some inputs. I'm going to show you what those are and how we can kind of lower some of these candidates. So let me show you those filters. Now, every trader is different. There's no right or wrong. I'm not saying my way is the right way, but I will walk you through my logic and see if this is something that might interest you. Now, first one that I added is the implied volatility rank. Implied volatility rank looks at the implied volatility of the individual stock and sees where that current implied volatility ranks in terms of the implied volatility of that stock over a 1-year period. What we want to look for is those stocks whose implied volatility is rising or in the top percentage for that year, higher premiums. That's the purpose of that. So I'm just using 50-50. I just want to see stocks that are in the top half of their implied volatility over the last year. Delta. Delta is a value that says how much is our option going to change for every dollar price movement in our stock. But it's also a probability value. So if I have a delta, let's say 0.5 or 50%, that means that there's a 50-50 chance that the stock price will get to my strike price. And if I want my stock to get to my strike price at expiration, I might want to take on a higher delta, more likely probability. But there's a caveat. And the higher the delta, the closer I'm getting to current price, and maybe even into higher deltas into a in the money price. So for our assessment here, we want that price appreciation, right, to get that greater potential. So we're going to look at deltas that are out of the money, right, a little bit out of the money. So we're going to look at deltas in that 20 to 40%. And for me, I kind of like to find them right around that 30. That's kind of my wheelhouse, right? In other words, I get a 1 in 3 chance that I'm going to see my stock get to my strike price. Days to expiration. Again, this goes back to our theta or our theta decay. Our options are wasting assets, and as we get closer to expiration, the value of the option decreases. So, again, a lot of traders will tell you, hey, I want to sell an option. I want that to evaporate as quickly as possible to collect that premium. But we want to use this as an opportunity to collect a greater premium. So I might want to look to sell an option of greater time value. That's going to increase my premium. Plus, remember, we want price appreciation. I want that stock to rise in price. Going to let it bake, right? I want it to rise. So I'm going to look for a little bit wider time frame. Also, this also might give me an opportunity to collect the dividend, depending if that stock has a dividend. And then there's our static return. And again, I just use a very minimal threshold of 1%. So we went to the screener. The screener was showing us 1,000 opportunities. Too many for us to look at. So with just a few minor adjustments, my implied volatility rank, my delta, my days to expiration, and my static return, the screener now is going to narrow down my candidate field. And look what it does. It only gives me 33 potential candidates. And what's kind of cool is I really like this for today. The market helped me out. Is the top one is AMD, Advanced Micro Devices. So let me go back to my slides. Excuse me. And so what I did was, in preparation for this webinar, I went to the screener a few weeks ago and set up a trade based on what the screener, buy screener. And again, AMD was there. So let me walk you through this, and then we'll talk about rolling up. So first of all, when we start thinking about this strategy, again, we want to be slightly bullish, or we want to see a stock that has positive momentum. If we just look at this stock without the details about the trade, we can see that this stock is in, a very positive momentum. A lot of cycles of consolidation, positive consolidation, impulses, positive consolidations, impulses, and again, another impulse. So every time AMD impulses, you can see that impulse, 60%, 30%, right? So I'm anticipating that I'm going to see another impulse. Here is my consolidation, right? And I'm waiting for that opportunity, that breakout opportunity, to put this strategy on. Now, this chart is a weekly chart, but let's walk through the values here. So my initial purchase price for that stock was $112.50, and there you can see it right here. The 125 December call was trading $3.15. So I'm going to sell that call and bring in $3.15 of premium. And that will make my net investment, my break even, my net debit, all the same at 109.35. The 112.50 minus the $3.15. And that is represented here by this red line. All right. What were those other considerations? Potential profit and static return. So here's my potential profit. I'm going to buy the stock at 112.50 and I'm selling a 125 strike. If price gets above 125 at expiration, I'm going to appreciate by $12.50 plus the $3.15 that I already took in for a premium. That's going to create a $15.65 profit. Take that $15.65 profit divided by our net investments, that 109.35 is going to create a potential return of 14.3%. Notice that I set this trade up just trying to capture a small percentage of one of the last impulses. I'm not going to be a pig. I'm not going to be greedy. I'm going to try to capture maybe a third or maybe a half of some of the performance values that I've seen in the stock over the last month, 6 months, or the last year. Notice I'm only trying to capture 11% price movement. That 11% price movement is going to return me 14.3%, enhancing that return. What is my unchanged scenario? What if the stock doesn't rise in price? Well, I'm going to take in $3.15. My net investment is $9.35, and that would give me a static return of 2.9%. Now, little disclosure here, and I apologize. The formula that I am presenting right here in our screener is actually that flat return. The static return will use the initial price, which would have been $12.50. So what we're actually seeing here is the flat return. But still, we're getting almost 3% for 60 days, right? We're talking about a trade that we put on in October, and our expiration is not into December. So that would work, right? About 1.5% for 60 days, for 30 days. All right, so that's basically the way we set this trade up. Now, let's go back to ADM and look at what has happened since then. All right, let me move this back over here. So this was the day, October 18th, that breakout day where we bought the stock and we sold the call at the same time. And then you can see that our stock price moved up significantly. And within a few days, maybe a couple of weeks, we were now above our 125. But we're not anywhere near our expiration, right? We still have a lot more time. So at this point, what are our options? What can we do? So we can do something called roll up. And roll up will increase our profit potential. But it also will have to give away some of our downside protection, that break even, by the amount of the debit required for us to roll up. So let's walk through this process. So what I'm waiting for is that our stock price finishes above, in other words, closes above that strike price, not these piercings here. We want to see it close. So at this point now, what I could do is I could buy back that $125 call that I sold for $3.15 and roll up and sell a call at a higher value. So I'm going to roll up to the 140 call. So on this date, I think it's November 2nd, at the close of the day, the December $125 call that I originally sold is now trading $8.55. So I'm going to buy that back for $8.55. And I'm going to sell the 145 call and collect $3.15. It's kind of erotic that it's the same value. But remember, I already took in $3.15 when I originally sold the $125 call. So $3.15 plus $3.15 is $6.30. And so my net debit, the cost to roll up to the 140 call, is going to cost me $2.25. Now that $2.25 in additional cost, this is something we have to think about. Do I want to roll up, or if I roll up and I pick a strike, is there enough potential reward to justify the cost? Now, in this case, it's only going to cost us $2.25 in net cost, where in potential, I could get another $15 from 125 to 140. If I think about that in terms of a risk to reward ratio, that's about 6 to 1. That's a good risk reward ratio. That is definitely worth doing the roll up. But what if I do the net debit and it only gives me a 1 to 1 or a 2 to 1? Well, then maybe what I might do is just let the trade go to maturity. But there's no guarantee that price will stay above 125 between now and December. So what can I do? Well, I could close out the position. Am I going to get my maximum profit? No, because I'm not at expiration. I'm above my strike. And this is where the covered call strategy underperforms just owning the stock outright. Now, if I did the numbers and I spent the time doing it with you, it would come out around 8%. It still would be a good return on my money over a 2-week period. Nice return on that stock. But there are opportunities sometimes where the market will offer us an opportunity to create greater value if we roll up to a further expiration, lowering that debt requirement. And if it's a stock that produces a dividend, give me another 30 days or 60 days to capture that dividend. So on the same day, the January 140 call was trading $5.45. Now remember, we took in $3.15 on the $125 call. So that comes to a value of $8.60. Cost me $8.55 to buy the call back, the 125 call. So I'm actually creating a net credit of a nickel. And that value is going to lower my break-even point by a nickel. So when I do this decision about rolling up, and I believe that it's worth the value, the other thing I need to understand is I'm increasing my profit potential, but I'm also taking on more risk, right? The exposure to the price risk that this stock price goes back down. In this example here, in the first one, going back to the December, I'm going to roll up and it's going to cost me $2.25. If I add that $2.25 to my break-even point, that's going to put me around $11.60. Whoop, there it is, right around there. Whoop, there it is, $11.60. Notice that my break-even is still below my initial investment price. I like that. That's good. I don't have a problem with that. I think that's a good spot to start thinking about. But if I feel that this stock could retrace by, let's say, 10%, remember we talked about 10% earlier, and I roll up to like 120 or 122, my break-even price, then maybe I'm just going to let this trade, close this trade out, and put this money to better use. I plan to trade, I trade my plan. All right. Okay. So where are we at? Oh, we're right on time, right on schedule. All right. So I see some questions popping up. Gene, any questions that are kind of general questions or kind of the same?
Well, the question we always get is, will I get a recording of this webinar afterwards. And yes, everybody will get an email later on this afternoon with the link to the recording. And all of our webinars are archived on our webinar archive page, which I think John will show you later on toward the end of the session. So yes, it is being recorded. Yes, you will get a link to the recording.
All right, so I see a couple good questions here. Let me see if I can answer. First one looks like it's from Al. If it's not how you pronounce your name, I apologize. But he's saying, how does dividends affect the option? So what normally you'll see is that the premiums of the calls that we're going to sell, if we're way away from the ex-dividend date, not a lot of effect. But as we get closer to the ex-dividend date, you will see that premium fall by about the amounts of the dividend that's going to be created. Now, after ex-dividend, your stock will actually fall. So don't think that you figured out a strategy. I'm going to buy a stock before the ex-dividend date, sell the call, and then the next day get the dividend, ex-dividend date, and take the trade off. Well, the market has already figured this out. It's already discounting that information. So it's less effective as far away we're from the ex-dividend, but as we get closer, you will see that effect on you. So Jeff asks, if the option is not exercised on expiration day, do I still want the stock, right? So that's a great question. It depends on, is this a stock company that you believe in? But at that point, if you own that stock and now it's settled right on your strike price and you've created that maximum profit, so Jeff, why don't you sell another call, right? And yeah, you're going to have a break-even price that's going to be higher than your original break-even, but you've already put X amount of dollars in the bank. So why not stay with a trade that is working and just keep rolling it forward? And we could continue to do this into perpetuity until the market turns around on us. So Wayne asks, he says there are only 33 possible candidates when almost all of them are stocks that start with A or B, or isn't that just the first page of the result? No, it was 30. It's just a rarity, Wayne. I don't know why I did that. I mean, I'd go back to my screener, and if I scroll down, yeah, there's some Z's and V's in there, Wayne. Okay, so I think it's just the first few that you just saw, all right? And let's see, Stefan asks, when looking at stock with high volatility, I noticed that a recommendation to put on a stock that is trading at $5 and a strike of $8. Why would a person enter this type of trade? I see the premium is high, so that makes it interesting. Yes, David, think about it. It's not about the absolute price of a stock. It's about that relationship between the value of the call that I'm going to sell, the premium I'm going to collect, the value of the stock, how much does the stock have to move, right? It's all about leverage. It's all about the numbers, right? So if it's a $1 on a $5 stock, or it's $10 on a $500 stock, doesn't matter. It's still the same math. It's just which one do you want to do? Which one has your risk tolerances, okay? Bob asked about deep in the money call strategies. Bob, that would be for another webinar, but Bob, do me a favor, send your question to support. We have some really great individuals that work in our support team. A lot of them are astute options traders. That would be support@.com. Send that question to them. They'll answer that question for you, okay? All right. So before we jump away here, I do want to talk about a couple of things that are kind of cool for you guys. So one of the mantras that we have at Barchart is, let Barchart do the work for you. In other words, let's work smart and not hard. So I'm not sure if you guys are aware of one of our contributing authors. We have an author, his name is Jim Van Meerten, and Jim creates something called the chart of the day. It's under the news section. Now, Jim is a momentum trader, and he has this system where he uses the pages on Barchart to find the best of the best of momentum stocks. And he produces this newsletter every day that reveals that choice. So let me show you that. So I'm under news. There's chart of the day. There's Jim. Sometimes Jim's in our sessions. If Jim's in the session, hey, Jim, how's it going? And you can sign up to get this chart of the day, right? You can get that for free. But notice that here's some of the stocks that Jim has chosen over the last 7 days. ADP, ENTG, PAC. There's our AMD, right? BBY, Best Buy, and so on and so on. So what I did was I created a watch list of the 7 or 8 or 10 that Jim had put up over the last week and a half. Now, there's a couple in here that I have found too good in momentum stocks. One of the ones I think is that wasn't Jim's was General Mills, but be that as it may. So Jim has already found the momentum stocks for us, right? So I don't need to go through the screen. I don't need to go and do all that process and tweak it, right? Just look at these stocks. And I can just quickly look at them using our mini chart view and see that, yeah, look at all these stocks. They're all have nice positive momentums. So all I need to do now is pick a stock, Best Buy in this case. Now I'm on the Best Buy page, and underneath the options section for Best Buy is cover calls. And all I need to do now is pick the length of duration of my option. December, a monthly. And the cover call will now lay out all those strikes based on current price and over that time until December 17th. So there are some that are in the money, some that are at the money, and some that are out of the money. And I can do that process, look at my moneyness. How far do I think Best Buy can move in the next 30 days? How much return am I going to get? And do that math and look at that static return. Is it worth for me to take this trade based on if the stock doesn't move? Work smart, not hard. Okay. Let me go back to my slides. So what are some takeaways for you guys? Well, remember, the buy right cover call strategy is best suited for stocks that have this steady positive momentum, right? We're going to try to enhance a momentum trade. If our stock shoots up too fast, we're not going to get that maximum profit. It's still going to be a profitable trade. I could roll up, make sure I do that process, make sure the cost of the rolling up is worth the potential that I'm going to get, or I set a trade and plan. Now I'm going to execute it. Once price gets above my expiration price, my strike price, I'm going to take the trade off, put that money to work in another trade. Remember, maximum profit can only be achieved if that stock ownership is taken away from us. What are those 3 comparisons we're going to look at? Our potential return, how much return that I'm going to get for that trade. Again, how much premium I'm going to take in versus my net investment. What is my break-even point? How do I determine what is that value? Well, it's that credit I take in minus my initial investment. How much downside protection do I want to get? If I want a lot of protection, I'm either going to have to give out a lot, take out a lot of time, trade a more volatile market. or I need to be closer to current price. If I'm willing to give up a little bit of downside protection, then I might be able to set a strike even a little bit higher, maybe a little bit greater profit potential. What is my static return, right? What if I'm right that the stock has positive momentum, but it doesn't really go anywhere? It doesn't get to that 10% achievement. It doesn't get to that 25%. I picked a strike that's too far. I overestimated how far it was going to move. I want to get paid for picking a good momentum stock. So I have a threshold that I want to use. How can I do that? I'm going to look at my static return. And one of the most important parts of all trading is risk management. And although the strike premiums that we're going to collect and the dividends that we're going to collect can offset our initial investment costs, it does not protect us from downside price risk. We still need to set stops. We still need to pick a value where we have determined where we're wrong and we're going to get out of that trade. Now, the most likely level would be our break even. But I'm going to tell you right now, if your stock is at break even before your expiration, you're going to lose money. You're not going to break even because the call might still have value as you have to buy it back. And now your stock is actually lower than the initial price that you paid. So you will lose money. But where is that value? Where is that value where you have decided that you're wrong about momentum and you want to get out of that trade? This is an important concept for this trade. What I don't want to see you do is sell a cover call and say, oh, I'm just going to ride this out, right? Yeah, maybe you might have brought in, 4 or 5% or 3% on the value of that premium, but to allow that stock to go down 10% or 20%, that's not smart trading. So make sure you have a plan in terms of case this trade goes against you, and in other words, that risk assessment to the downside. Okay, where are we at, Gene? Well, a little early, but right on time. So what do we want to do next, Gene? I know what we want to do next.
You do?
Yeah.
That's good.
I think this is what you wanted to do next too, right? So first of all, before we talk about upcoming webinars, let's talk about that archive and that one with Jim. And it's actually with Jim and Gene. It's really entertainment. Gene, just help me out. Do you remember where that was under? Is that under?
Oh boy.
Trading ideas? Am I putting you at the?
You're putting me on the spot here.
I'm sorry. It's in here.
Pre-membership tools, maybe?
Yeah, I think you're right. Maybe. I didn't mean to do that to you, Gene. I apologize.
Yeah, let's see.
There it is. Okay. Yeah, Gene and Jim did a really good job. And do you want to talk about that, Gene, for a second?
Well, just it goes through how Jim picks out all these stocks that he features in the newsletter. So if you're interested in how he does it and what his thought process is, that's a really good one for you to watch.
I've certainly enjoyed it. I thought it was really fascinating. And again, working smart instead of hard. So upcoming webinars, we can see that we don't have any. So next week, we're going to take off for Thanksgiving break, but we'll be back in the first week of December. And then to finish out the year, we have a couple interesting subjects that I think you folks are going to like, but I'm not going to reveal them right now. I'm going to tease you a little bit so you come back, but we'll have that up in the next week or so. So sign up for that upcoming webinar that will be in the first week of December. So for those of you who are going to be traveling for Thanksgiving, Gene, I want to wish you a happy Thanksgiving and safe travel.
Thank you, John. Same to you.
I want to wish everyone the best of health and the good of all trading.